Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce, and today we have a lot to unpack because the Fed just made its June announcement, and I want to give you not just what happened, but why the framing most people are using to interpret it is wrong, and then I want to bring it right back to what it means for you in terms of borrowing costs, so let's dive right in. The Fed held its meeting today. It held its rate steady at 3.50 to 3.75. That is the short-term rate. And the hold itself was not the news. The news was in the dot plot. This is the median projection for where rates end 2026, and that's an average of 40 basis points more than it is today. 9 out of the 18 members of the FOMC believe that rates will increase between now and the end of the year. The other half are suggesting that it's going to remain constant. None were suggesting that rates will fall. It means for the 9 members who believe that rates will increase, they're in fact pricing in 2 rate increases between now and the end of the year. So we have the double whammy of both rising inflation, today at 3.3%, that's the core PCE measure that the Federal Reserve likes to use, and unemployment was revised up to 4.3%. We have both rising inflation and rising unemployment in the same forecast. That is stagflation by definition. And if you've been in this business long enough, you know what that means. The Fed is backed into a corner. So let me tell you why they're backed into that corner, because this is almost nobody talking about this out loud. Oil went from $53 a barrel at the start of the year to $112 because of the Iran conflict. It's retreating now, call it, say, $76 a barrel, on the announcement of the peace deal. That move from 53 to 112 and back down had absolutely nothing to do with the Fed funds rate. Rate hikes can slow down the economy. They can reduce demand for anything that involves credit. What they cannot do, even a little, is increase the supply of oil coming out of a war zone. They cannot reopen a blocked shipping channel. They cannot convince OPEC to pump more barrels. In fact, here's the crazy part. We are at tank bottoms in Cushing, Oklahoma. This is not the strategic petroleum reserve. This is the oil reserve that feeds the majority of the refineries. A lot of people focus on the strategic petroleum reserve as an indicator of inventory, but the tank levels in Cushing, Oklahoma are far more important. These levels need to be maintained at certain minimums, I think it's about 30 million barrels, in order for the refineries to operate. And if the flow of oil were to stop, even briefly, it would force refineries to shut down in a disorderly manner. Restarting them would not take hours, it would take weeks. So prices this low combined with real inventories at tank bottoms is unprecedented, and it's not an accurate reflection of the true supply-demand situation. Now, when inflation is driven by supply shock, rate hikes do nothing to suppress demand. They're attacks on every aspect of the economy, on the borrower, on every business, on every buyer of real estate, without solving the actual problem. And the Fed knows this. Incoming Chair Kevin Warsh basically said as much in the press conference today, acknowledging that supply-side normalization is incomplete. But their mandate requires them to respond to inflation regardless of the origin. So here we are. Now, it's not just the Fed. The European Central Bank hiked for the first time in 3 years this month. The Bank of Japan also increased. They're now at 1%, a number that would have been like science fiction 5 years ago. All 3 of the world's major central banks are tightening simultaneously into a supply-constrained environment. Switzerland held its rate constant at 0. Canada held its rate constant at 2.5%. But here's where it gets interesting for U.S. inflation. As the European Central Bank and the Bank of Japan are raising rates, that interest rate differential, theoretically, between those currencies and the US dollar would in fact start to compress. Theoretically, that should cause the dollar to weaken, but that's actually not what's happened. Since most countries are facing shortages of US dollar reserves, not only have commodity prices increased, but the price of the US dollar has surged as countries scramble for dollars to buy commodities that are now more expensive. So now let's talk about what this actually means for real estate, because that's where investors get this transmission mechanism wrong. People are watching the Fed funds rate like it's that number that determines the borrowing cost, and it's not. The number that determines your rate cap, your refinancing economics, is the 10-year Treasury yield. And right now, that's sitting at about 4.5%. That number is not going to fall dramatically just because the Fed eventually cuts the overnight rate. The 10-year reflects something different. It reflects the term premium, the market's compensation for holding long-duration government debt in an environment where the federal deficit is running at 6 or 7% of GDP. The Treasury has to sell enormous amounts of debt into a market where the Fed is no longer buying and foreign central banks are no longer accumulating at the pace that they did at one time. private investors step up. Some of them do, where they're looking for yield. And in that case, the 10-year stays elevated. So what does 4.5% mean on the 10-year Treasury? What's it mean for real estate? It means commercial real estate debt is pricing at somewhere between 6 and 7%, depending on the loan and the term and borrower strength. The 30-year residential mortgage is pricing between 6.5% and 7%. And that's the number that should be keeping some owners up at night. We've talked about distress in commercial real estate, but there's approximately an $875 billion wall of commercial real estate debt that was originated at less than 4.3%, and it now has to refinance at 6% or higher. That's a 190 basis point repricing shock on a massive pool of loans. If you're refinancing $20 million, that's nearly $400,000 a year in additional debt service. So deals that were underwritten with comfortable debt service coverage cushions are suddenly marginal. And we're already seeing it in elevated default rates, in particular in the CMBS market. Today, the CMBS market has a default rate around 7%. These are levels that were last seen during the Great Financial Crisis. In office specifically, the CMBS delinquency rate crossed 12%. That's not a rate problem. That's a structural problem. So where does this leave you? You want to watch the 10-year, not the Fed funds rate, and understand that if you're waiting for rates to come back down to where they were in 2021, you're going to be waiting for a long time because the fiscal dynamics that are keeping the 10-year elevated are not going away. If you're acquiring price for today's cost of capital and underwrite conservatively, and if you're refinancing, do it now rather than hoping for a better window that might not open. As you think about that, have an awesome rest of your day. Go make some great things happen. And we'll talk to you again tomorrow.